Good morning, everybody. Welcome to another day of Market Report brought to you by Mike Bjork. Today is Thursday. It is January 7th. We got just one economic news release scheduled for today, and that is the weekly jobless claims, which was kind of set us up for tomorrow with the Bureau of Labor Statistics job numbers coming out tomorrow. And tomorrow they're going to be expecting about, I believe it was like 210,000 new jobs created. So be prepared for some volatility, more volatility in the markets, even though it's been kind of displaced with other geopolitical activities that have been going on. But today we'll start out with the weekly jobless claims. We had 287,000 people apply for unemployment last week. Forecast was supposed to be at 275, and it pretty much came in at forecast at 277 this past week. So decent number. So it's still below 300,000, which we were kind of seeing last year, and so numbers are looking pretty positive for jobs. Stock market's down again. Today, again, a lot of it is due to, again, more issues going on in China. We had the Chinese yuan got devalued further after the bank infused all that money on Monday. As a result, their stock market went down and hit the 7% level and basically halted within 30 minutes, the fastest time frame ever, basically, even though it's only been 4 days. As a result, end of their stock day, the Chinese officials basically said they're going to go ahead and suspend this process, as it's, the complaint's been that it's exacerbating the problem. It's instead of letting it run its course, it's basically freaking out the investors a lot more, and the investors think that so the next day it just gets worse and worse and worse. So they're just going to let it run its course at this point going forward. Also, the oil price continues to slide. Now we're down to 32 and change per barrel, where yesterday we were in like 34, like 33, I think it was. So oil price continued to come down here. Yesterday we had the Fed minutes release. So the Fed's it was a very close call, even though it was unanimous. There were still concerns about inflation going up, especially with the stronger dollar, especially stuff that's going on in China. The oil price is coming down, so there's a lot of concerns that maybe that inflation may not go up as much as they like. They like to keep they look at the PCE, which is the personal consumption expenditure, the core. And they like to see that at 2%, whereas right now we're currently at 1.3%. Now, on the other hand, we do got the CPI, which is another one they look at, but that's at 2%. But their favorite gauge, which is more reflective of where the economy is at 1.3, and the PCE is the index that they kind of use their favorite gauge for consumer inflation. Let's go ahead and further take a look here at the bond market. Right now, we had, as you can see, we had a huge gain yesterday, and kind of lost a lot of that gain today. So we're down about 15 basis points so far this morning. So stock market down, and the bond market's down, and even the treasuries is down. So a lot of money is just getting pulled out of the market altogether, and until they can feel a little bit more safe as to where they want to put the money. So right now, if you got rates out there, it might be a good time to kind of lock in case there's any in case it goes back into equity markets. Right now, the stock markets are more in a panic selling mode because of what's going on in China, which has been kind of taking the beating this past week here. And that's not really good enough really to warrant it, because the domestic numbers that we're seeing so far have been proving that a lot of the global or geopolitical news isn't really affecting the U.S. economy. We're still going at a modest pace here. Not as fast as we'd like, but still at a modest pace. So based on that, you're going to see stock market will probably start going up at some point once they kind of get over this panic mode, and a lot of that will come at the expense of the bonds or interest rates here. So interest rates are a little bit worse today compared to where we left off yesterday. As you can see, the bond market is down. So the rule of thumb is if the bond market's down, rates are up. When bond market's up, rates come down. All right, folks, you guys have a great day. We'll see you guys tomorrow, and be prepared. Tomorrow we got the jobs numbers. Thanks for watching. See you tomorrow. Bye.